Hey everyone, it's Daniel here from InfoVest. Hope you're all doing well. I want to do a quick video on a article that's come out from Wall Street Journal. It basically says Fed set to raise rates by 75 basis points and debate size of future hikes. Now, it's basically being priced in now that we're going to get another 75 basis point rate hike, which is about 0.75 in November, which is coming in about, if I take a look at my calendar, in about 2 weeks. So I believe the date is November 2nd. But correct me if I'm wrong, but I believe that the date is November 2nd. That's when we're going to get the Fed meeting, and we're going to get the rate hike for November as a 75 basis point, as another big jumbo rate hike from the Federal Reserve. And then from there, the expectation is that December time we could get 50 basis points. That's where the market is kind of leaning towards. But we're not ruling out still a chance or a possibility of a 75 basis point. And a 75 basis point rate hike in December could come if, let's say, the CPI report comes in hot again, or higher than expected again in November. So we could get that. Now, what's very interesting in this article, which I want to talk about, is the fact that it's mentioning some dovish comments from from a lot of Fed members. And these dovish comments are coming out, and it seems like it's being perceived by the markets as that the Fed is starting to pivot. And again, once again, like we've seen it previously a couple of times this year, that the bulls keep coming out and are saying that, okay, the Fed is pivoting, the Fed is pivoting, the pivot is here, the pivot is here, and they keep buying dips here in anticipation that the Fed is going to pivot like right now. So the problem is, and I don't fully agree with that, although they may update in their December projections, and also don't forget anything can change, right? Even though that the markets are pricing in some sort of pivot, even though that the Fed members have come out and gave kind of a softer tone, saying that after December they're probably not going to be continuing the pace of the rate hikes. They're probably going to pause. They're probably going to stick with 25 basis point rate hikes instead of those jumbo 50 and 75. And a lot of Fed members came out and expressed that they don't want to over tighten. They don't want to over tighten and cause the markets to just completely crash, or just because of them. So of course their credibility is on the line. Both sides. One is not crashing the markets completely from over tightening, and second is also trying to bring inflation down, because that's their mandate. That's one of their mandates. That's one of their jobs, is to bring inflation down. So how do you do this, right? You're on this you're walking on a very thin string, a very thin rope, that you have to make sure that you don't tighten so hard that it causes a massive crash, and you're able to also bring inflation down. Now, even though the markets might be anticipating that the dovishness, or the fact that we're not going to raise rates as aggressively, we're going to slow down, we're going to pause, as a pivot, I still don't see that as a pivot, how the market is looking at it. I believe that if the markets rally on this pivot noise, on this pivot sound, I believe it's going to be short-lived. And I believe that a lot of people are going to look at this and say, okay, this is the dip, buy the dip, buy the dip. Well, I believe that dip buying is going to be short-lived, and I think a lot of longs are going to be caught on the wrong side of the trade. Just because we went through a full year of massive tightening, of massive rate hikes, the speed that we got to, of bringing rates from zero to all the way where it is right now, to close to high levels within just 1 year. Those effects And also, look at the bond market, right? The bond markets in the US and around the world are all selling off, and you're seeing yields jump, especially in the US, from 3% all the way to 7%, and they're continuing to go up higher. If you look at the 30-year bond, the yields, they're continuing to make new highs in terms of the yields, right? So the damage of that, what we've done this year, has yet to be seen within the markets, within the economy. And there's a lagging effect of that, right? There's a lag effect that when these policies come out, they have about 6 months for it to really show its effects in the markets. And the first rate hike that we did this year is the effects of that is showing just right now. It's just starting right now. And the effects of the rate hikes we're doing as of today and onwards are going, those effects we're going to see after 6 months. So there's a lag effect. Definitely the Fed is looking at lagging indicators and making a decision through those lagging indicators to raise rates aggressively. And now I think they're now coming to a consensus, or slowly it sounds like they're coming to a consensus that okay, they don't want to over tighten or break anything, so let's slow down a bit. And now the markets are looking at this and saying, okay, that's the Fed pivot, everybody, that's the Fed pivot. Let's go ahead, buy the dip. But I'm still not on, even though if we do get a rally, I'm still not 100%. I don't 100% agree with that rally, and I do believe that it's going to be short-lived. So for that, and for that reason, why I think that, you know, if a lot of people go long thinking that the effects of those rate hikes, and when it eventually comes, that we start to see data with jobs and unemployment rate and ISM manufacturing, when you start to see growth in jobs data in the US start to come off worse than expected, then I think that's when it's going to basically shock a lot of the market participants, especially when we look at earnings. And if we start to see earnings really deteriorate and we get an earnings recession, I think that's also going to cause the market, the equity market, the stock market to be to be shaken up again, which we might get that final leg of a sell-off, right? Now, where could I be wrong here, right? Of course, I could be wrong. I'm not a god in predicting everything, right? I can definitely be wrong. How I would see where my analysis would be wrong is basically if we do get a soft landing, right? We don't get a hard landing. Is if yes, the rate hikes that the Fed is doing, the economy is absorbing it, and we're getting higher growth than what than the expected rate hikes and the inflation that's eating up into people's savings and spending. If we do get higher growth and higher growth rates, and we're able to produce more and sell more and have sell and get more exports and get our exports up, and we're able to see more growth within the economy, then sure, right? The economy can absorb the rate hikes. If we are seeing that jobs are still doing well, companies are still hiring, then sure, we can absorb the rate hike. So that's where I would see that I would be wrong if the economy can absorb the tension and just blow by the amount of the speed that we're raising rates, and how fast we got to these levels. If they can withstand that and they're continuing to grow, then sure, then that's where I'm going to be wrong. But I'm on the camp that I don't think that's going to happen. I'm on the camp that I believe that eventually something is going to break. There are cracks, and I'm seeing it throughout the globe, when you look at the UK, you look at Europe, you look at Japan, all right, you look at also in the US, you're looking at trade, you're looking at prices and tensions between US and China, China especially, right? There are cracks which are pointing towards that there might be something that's about to break. What is it? I don't know, right? We will find out soon. But this article that has come out, the narrative of the Fed pivot, I don't think is gonna come just now. I don't think that, the fact that the Fed members are looking to reduce the pace of the rate hikes. They'll still probably continue rate hikes, but reduce the pace at it. And they've also mentioned to us that they'll keep rates high at high levels for some time. I don't think that's considered a Fed pivot, because you're still at elevated levels, and especially if inflation doesn't come down, the Fed wants to attack inflation, and if they have to, like we heard from Kashkari, they will continue to raise rates. So my take on when the Fed pivot will come is when something breaks. Then okay, yes, then I think inflation will come down, then the Fed will have to do something to save the economy, and then sure, you could see that okay, the markets will start to rebound and so on, right? So that's when I think the Fed will pivot. And also looking at the bond market, what the bond market is telling us right now, we see continuation of some selling. We're looking at, when I look at the yield curve, we're seeing kind of a steepening in the yield curve. Now the long end is selling quite a bit, and the yields on the long end are moving up, just because of this news of the Fed pivot that we're having here. So until I start to see a little bit more evidence from the bond market that okay, things are starting to shift in terms of that recession play, or that play where something's going to break, then yes, I will then say that okay, the pivot is coming. But right now, this article, even though other people in the markets might be saying the pivot is coming, even they may be thinking and buying the dip. I mean, this is not financial advice. You can do whatever you want, but in how I read this, I don't read this as the Fed pivot. Anyway, so let me know what you guys think. Leave a comment below, and hit the like button, hit the bell icon if you want to be notified on the next videos. Subscribe, please share this video around, and let me know what you guys think, whether this is the Fed pivot, whether we're going to see higher rates or not, or whether we're going to see something break anytime soon. Let me know. All right, I'll see you guys around. Bye. Cheers.